Before we begin today's episode, a quick note. This podcast is intended for educational and informational purposes only. I'm not a CPA, tax attorney, or a licensed tax professional, and nothing discussed here should be considered tax, legal, or financial advice. Tax rules can vary significantly based on your income, state of residence, and personal circumstances. And please review your specific situation with a qualified tax professional before making any decisions. Now, let's begin. So there's a moment many professionals experience that feels almost magical. Like you join a company, the offer letter looks good, salary is solid, bonus is nice, and then your eyes stop at one line, the RSUs. Suddenly the package looks very different. The number can feel enormous. Sometimes it is the line that makes the offer exciting. Sometimes it is that line that makes people stay, right? And sometimes it is that line that creates the biggest confusion as well. Because months later, when the first vest happens, you log into your brokerage account expecting a certain number of shares, and a large chunk is simply missing. It's gone. It's sold. It's taken away. And that's when the questions begin. Why did I lose so many shares? Why is this tax already? Am I paying tax twice? And perhaps the biggest question of all, is there anything I should do to avoid overpaying taxes? So today, I want to walk through this carefully because RSUs is one of the most misunderstood parts of compensation. And once you understand one simple mental model, everything becomes very clearer. So let's start at the beginning, right? Imagine your company grants you 1,000 RSUs over 4 years. Now, that may be small, that may be big, right? At this stage, nothing taxable has happened because this is very important to understand. The grant is simply a promise, it's not yet yours. The IRS does not tax a promise. Now, tax begins only when the shares vest and become your property. So, that vest date is the key event. Let's say 250 shares vest today. And suppose the stock is trading at $100 for simplicity. And that means you have just received $25,000 of compensation. Now, here is the most important idea of this entire episode. RSUs are taxed exactly like your paycheck. I'm going to repeat this slide one more time. RSUs are taxed exactly like your paycheck. That's it. There is no mysterious special tax. There is no hidden equity tax. There is no exotic formula. There is no capital gains tax as well. The capital gains will come later. I'll explain that later. But from the tax department's perspective, this is simply a compensation income reported on your W 2. The only difference is that instead of cash, you receive stock. This is where many people get surprised. You expected 250 shares, but maybe only 160 shares land in your account. The rest was automatically sold, and this is called sell to cover. Your employer sells part of the shares immediately to cover withholding taxes. Now, think of this like payroll withholding, right? It's just like you receiving less salary than the employer initially promised you because they withheld some for taxes. Um, Same exact principle, just shares instead of dollars. It's simply a tax prepayment. Now let's address this famous fear. Like, does that mean then the one almost everyone asks me is, am I getting taxed twice on RSUs? The short answer is no, but it can absolutely feel that way. Now let me walk you through why. Suppose your 250 shares vested at $100, and that's 25,000 already taxed as ordinary income. Now let's say you decide to keep holding that stock, and 6 months later the price rises to 120. Now you sell. Now it's 120 times 250, that becomes $30,000, right? So now what happens is, I've already paid tax on a 25,000, right? And I need to pay capital gains on the 5,000, the $20 extra that increased on each share, right? Together comes out to be $5,000. So that becomes a capital gains. Now, of course, it's 6 months, 1 year. If you sell it after 1 year, it becomes long-term capital gains. So that's even better. But if you forget about that for a moment, it's $5,000 will be taxed. And these two are two separate economic events. So first, you got paid. Second, your investment increased in value. And those are taxed differently. The first is your ordinary income, then the second is capital gains. There's no double taxation. This is simply two different chapters of the same story. In fact, there's an easier way to think about it. The moment RSUs vest, imagine your employer handed you cash instead. Now, then imagine you immediately use that cash to buy a company stock. That is economically almost identical. Once the shares vest, they stop being RSUs. They are simply stock that you own in a brokerage account. And from that point onward, they behave exactly like the stock investment. If it goes up, capital gains tax applies. If it goes down, you may even have a capital loss. This mental model removes the huge amount of confusion. Now let's talk about the real tax trap, right? And this is the part where many people discover only during filing season. The tax withholding may not be enough. This is especially true for people whose total income pushes them into higher federal and state brackets. Many employers withhold RSUs at a standard supplemental withholding rate, but your actual marginal rate may be significantly higher once salary, bonus, RSU, state taxes, medical surtax, and other income are included. And this is where people get surprised in April. They assume taxes were already taken care of, and then they owe a very large balance, sometimes shockingly large. This is why tax planning around RSUs is less about avoiding taxes and more about avoiding surprises. So what should someone specifically actually do, right? There's three practical things you could do. One is estimate the tax shortfall. Every vesting event should trigger a quick tax check. How much was withheld? What is your actual marginal bracket? How much state tax applies? If the difference is meaningful, adjust the payroll withholding or make quarterly estimated tax payments. This alone can save a lot of stress. Now second is review whether to hold or sell. Now this is not just tax planning, this is wealth management. Ask yourself one simple question. If my employer paid me cash today, would I use that cash to buy this stock? If the answer is no, that is straightforward then, right? Because holding vested RSUs is essentially making an active decision to invest in one company. The same company that already pays your salary. That creates concentration risk. Your paycheck and your investment becomes tied to the same source. And this is the risk many people underestimate. Now, the third thing you need to do is check cost basis carefully. This is where the real accidental overpayment happens. Sometimes because the brokerage statement on 1099B may show an incorrect cost basis. If your CPA or tax preparer misses this, it can look as if the entire sale proceeds are taxable. That creates an illusion of double tax. This paperwork issue can be expensive. The correct cost basis is generally the fair market value at vesting because that amount was already taxed as income. This is one of the most important things a tax professional should verify. And perhaps that's the real lesson here, is that RSUs are not complicated, but they are emotionally confusing because they say right at the intersection of salary, investing, and taxes. Once you stop seeing them as mysterious stock compensation and start seeing them as paycheck first, investment decision second, everything becomes simpler. Tax at vest, capital gains after that. No true double taxation. Just compensation followed by investing. And once you understand that, you stop fearing RSUs and you start managing them intelligently. And again, I want to repeat the note that we began with before we wrap up. This discussion is purely for education and general understanding. I'm not a tax expert, and a tax decision should always be reviewed with your qualified CPA or a tax professional who understands your personal situation before you act. Please use this episode as a framework for understanding the concepts and then discuss your own numbers and decisions with a qualified professional. Thank you very much for listening to this episode. This is an OMC real estate podcast, and even though it says real estate podcast, sometimes we discuss topics that are not related to real estate. Our website is oldmoneycapital.com. I would like you to visit oldmoneycapital.com and click on request a call button so that we can tell you how we can help you in saving taxes by investing in multifamily syndications. Our Instagram account is oldmoneycapital123. And if you haven't subscribed our YouTube channel, Old Money Capital, then please subscribe it. Thank you very much once again.